In early February 2025, the U.S. Canada Economic Partnership faced an unprecedented threat. President Donald Trump's contentious decision to slap high tariffs on Canadian goods, citing worries about illegal immigration and the rising problem of fentanyl trafficking, sparked escalating trade tensions. Trump's statement on February 4, 2025, which included a 25% duty on all Canadian imports, was a direct response to what he saw as Canada's inability to solve border concerns, including the flood of fentanyl into the United States. The tariffs were intended not simply to solve border issues, but also to change the dynamics of trade in North America. A 10% tax was imposed on Canadian energy exports, causing a direct impact on the country's vital oil and gas industry, which plays an important part in the economy. In reaction to the tariffs, Canadian Prime Minister Justin Trudeau quickly announced retaliatory measures. Canada would apply a 25% charge on $30 billion in U.S. imports, beginning on the same day that Trump's tariffs went into force. Trudeau also indicated that this response might include an extra $125 billion in U.S. imports, subject to a 21-day consultation process. Canada targeted a wide range of American items, including beer, wine, whiskey, fruits, juices, apparel, sports equipment, and household appliances. However, after several heated conversations between the two leaders, a brief reprieve was given. Both countries agreed to suspend the application of these tariffs for 30 days. Canada, in turn, pledged to strengthen its border security procedures. This includes appointing a new fentanyl czar to supervise efforts to reduce the illegal flow of narcotics into the United States, as well as forming a combined strike team to battle drug trafficking. Although this agreement avoided immediate economic consequences, diverse views inside Canada remained. The economic implications of the tariff war. Despite the short delay in tariffs, the situation remained unsettling. Economists cautioned about the long-term repercussions of these trade restrictions, especially given the two countries' substantial interdependence. The United States and Canada have one of the world's most interconnected trading ties, with annual trade flows of products and services totaling hundreds of billions of dollars. Any disturbance to this link might have ramifications across industries, resulting in increased consumer prices, disrupted supply chains, and decreased market stability. One of the most severely impacted industries would be the Canadian oil industry. Canada is the world's fourth-largest oil producer, producing around 5.76 million barrels per day as of 2023. Historically, the United States has been the primary market for Canadian oil, receiving the vast majority of shipments. However, as trade tensions escalated, Canadian oil producers faced the threat of losing their main customer. As a result, they switched their focus to other overseas markets, notably those in Asia. The Trans Mountain Pipeline, one of Canada's most important infrastructure projects, has become key to this transformation. The pipeline that delivers oil from Alberta to the Pacific coast has increased its capacity to 890,000 barrels per day, nearly triple its previous flow. This project, which will be finished in May 2024, provides Canada with a more direct path to Asian markets, and oil producers are now trying to take advantage of this opportunity as demand from nations such as China rises. The pipeline's additional capacity has already resulted in an increase in supplies to Asian refiners, with nations such as China, Japan, and South Korea boosting their purchases of Canadian oil. Rongsheng Petrochemical, a Chinese refiner, has acquired numerous cargoes of Canadian petroleum in late 2024, demonstrating China's rising demand for heavy crude oil. This market move is part of Canada's overall goal to lessen its reliance on the United States and diversify its oil export portfolio in the face of uncertain trade ties with its southern neighbor. Canada's oil output has increased dramatically in recent decades, thanks in large part to Alberta's huge oil sand deposits. As of 2023, Canada is the world's fourth-largest oil producer, after only Russia, Saudi Arabia, and the United States. The country's oil sands, which are predominantly found in Alberta, are the world's third largest known oil reserves, with an estimated 180 billion barrels. This massive reservoir has been the foundation of Canada's oil industry. In 2019, Canada produced an average of 4.7 million barrels per day, with unconventional oil sands accounting for around 64% of total output. By 2023, the amount had climbed to 5.76 million barrels per day, reinforcing Canada's position as a major participant in global energy markets. While Canada's oil sector has greatly benefited the economy, it has also caused environmental issues. Critics say the country's continuous investment in oil extraction projects, such as the Trans Mountain Pipeline expansion, contradicts its commitment to climate action. Canada has established aggressive emissions reduction objectives and enacted initiatives, such as a national carbon price. However, the conflict between its environmental aims and continued expenditures in fossil fuel infrastructure remains a source of dispute. The argument over whether Canada can combine its economic development with its climate action goals continues, notably in the oil sands industry. While tensions with the United States dominate the news, Canada has discreetly strengthened economic ties with other major powers, most notably China. China is now Canada's second-largest economic partner, after the United States, with bilateral trade expected to reach $25.4 billion in 2022. This developing connection represents a widening of Canada's export markets, particularly in light of trade uncertainties with the United States. In 2023, Canada shipped a wide range of products to China, with oil seeds and oleaginous fruits, particularly canola, leading the way. Canola shipments to China skyrocketed, up 75.2% from the previous year. China's recovery from COVID-19, as well as rising demand for agricultural products, contributed to this spike. Other significant exports to China were iron ore, copper, coal, and wood pulp. These commodities are critical to China's industrial growth and demonstrate Canada's role as a major raw material provider to the Asian powerhouse. Despite the developing commercial ties, Canada's trade balance with China is still negative. Imports from China reached $100 billion in 2023, up 16% from the previous year. The trade imbalance with China has generated worries about the relationship's long-term viability, but Canada continues to diversify its export markets as a risk mitigation strategy to lessen reliance on any single trading partner. This expanded study would include additional crucial topics, such as the larger consequences of trade tensions, the social and political ramifications inside Canada, and a closer look at the current geopolitical dynamics between the United States, Canada, and China. One of the most pressing worries for Canada following the introduction of U.S. tariffs is the possible economic impact on Canadian consumers. With a 25% tariff imposed on a wide variety of U.S. goods, analysts warn that the typical Canadian consumer may face increased pricing on daily things such as apparel and home appliances as a result of these trade disruptions. The levy on Canadian energy exports, albeit less substantial in percentage terms, may result in a rise in fuel costs, further pinching Canadian household budgets. Industries that rely significantly on U.S. imports, notably the car industry, might be badly impacted. Canada's automobile sector, particularly in Ontario and Quebec, is inextricably linked to U.S. manufacturers. These tariffs may cause delays, increased manufacturing costs, and even layoffs if supply networks become increasingly disrupted. The United States is Canada's principal destination for automobile exports, and any interruptions in this sector might have long-term consequences for Canada's manufacturing capacity. Prime Minister Justin Trudeau, who has long positioned himself as a leader devoted to multilateralism and a close relationship with the United States, is under intense political pressure. The tariff announcement, as well as the larger global uncertainties, had an impact on his approval ratings. Some saw his decision to negotiate with the United States to delay the application of tariffs as a pragmatic move to avert an immediate economic catastrophe. However, it drew condemnation from Canadians who felt the country should resist U.S. coercion. At the same time, there is a rising attitude in areas of Canada that the country should reconsider its trading reliance on the United States. As tensions rise, some political leaders have urged strengthening economic relations with other world powers, notably China. These talks highlight concerns about Canada's foreign policy future, with some advocating for a more diverse trade portfolio that lessens the dangers associated with being economically dependent on the United States. The larger geopolitical scene is also altering as Canada negotiates its relationship with the United States in the face of China's rising power. Canada's burgeoning trading connection with China, which has progressively risen in recent years, has proven to be a double-edged sword. On the one hand, it allows Canada to diversify its trading partnerships while reducing its reliance on the United States. On the other side, it exposes Canada to the geopolitical tensions between China and the United States, which have increased in recent years. The potential of Canada deepening its relations with China has stirred concerns in Washington. The United States has long been concerned about China's expanding worldwide influence, and it sees China's developing economic links with Canada as a possible danger to its own geopolitical stature. The Trump administration's statements about Canada potentially becoming the 51st state of the United States might be regarded as an attempt to put pressure on Canada to realign itself with U.S. strategic interests, especially given the developing U.S.-China competition. China, for its part, is eager to retain and strengthen its commercial ties with Canada. In addition to acquiring Canadian oil and agricultural goods, China has made significant investments in Canadian real estate, mining, and technological industries. These investments have increased economic interdependence between the two countries, but they also provide their own set of problems. China's expanding economic dominance and worldwide influence may put Canada in a hazardous position as it attempts to balance its economic interests with the United States and China. Looking ahead, Canada's long-term strategy may include significantly diversifying its trade connections, lessening its reliance on both the United States and China. Recent changes in global energy markets, including increased demand for oil and gas in Asia, provide an opportunity for Canada to expand its market access outside North America. The Trans Mountain Pipeline extension, completed in May 2024, is a significant component of this strategy, providing a direct route for Canadian oil to Asian markets, notably China. However, this diversification has its own set of issues. Canada's commitment to tackling climate change and lowering greenhouse gas emissions affects its plans to increase fossil resource exports. The government has lofty ambitions for reducing its carbon impact, including the implementation of a countrywide carbon price. However, the development of the Trans Mountain Pipeline and increased oil shipments to Asia highlight the ambiguities in Canada's climate policies. Environmentalists have attacked the Canadian government for prioritizing oil exports over climate action, claiming that the continuous growth of oil extraction projects violates the country's long-term environmental aims. The dispute over the Trans Mountain Pipeline highlights the conflict between economic expansion and environmental sustainability. This dilemma will continue to impact Canadian politics and policy as the country strives to combine economic interests with environmental responsibilities. As of February 2025, the trade dispute between the United States and Canada has not been settled. Both nations are currently in discussions to seek a more lasting deal before the next tariff deadline. The Trump administration has stated unequivocally that if Canada fails to satisfy its expectations for border security and drug trafficking, it would take severe action. At the same time, Canadian authorities are striving to reduce the economic impact of tariffs and prevent further escalation. The delay in tariff implementation allows for some breathing room, but the fundamental concerns of fentanyl trafficking, border security, and trade imbalances remain unaddressing. For Canada, the way forward will need cautious diplomatic maneuvering. As it strives to preserve strong economic links with the United States while strengthening its partnerships with other global powers, notably China, Canada must also overcome internal tensions and growing political resistance to its existing trade policy. The conclusion of these discussions will have far-reaching consequences, not just for the U.S.-Canada relationship, but also for Canada's position in the global economy.